Well, stocks at or around their highs for the year as companies report pretty strong earnings. But the big question right now, where do we go from here with the market and the broader economy? Art Hogan, the chief market strategist at Jefferies, joins us now. Art, your insight, what do you think? I mean, we've had more than 80% of the companies in the S&P 500 report better than expected numbers. Is this a reflection of the real economy, do you think?
I really think it is. I think it's interesting. So you've got 83% of companies that have reported so far, about 175 of them in the S&P 500 have reported better numbers on the bottom line. But the top line is as important. 65% of companies have beaten on that revenue estimate, and 75% of companies that beat actually raised their guidance for the rest of 2010. So what that's done, oddly enough, in the background is taken the estimate for the S&P 500 for 2010 from about $75 to about $80. During the 2 weeks we've been reporting earnings, and it probably gets up to $82 by the time we're done. And on a sort of any kind of conservative multiple that you put on that, stocks are still relatively attractively valued. And I think that's why we continue to see this market inch its way higher, with reluctant investors coming in and just ignoring things like Greek sovereign debt and Goldman Sachs' crisis and things of that nature. So it's a real earnings focused market, and I think that's a positive thing.
What about the banks, though, specifically? Are they a bet where you'll place your clients' money right now? I mean, great numbers really across the board, but then you've got issues. You've got more and more lawsuits popping up. You've got a big one that's going on right now against Wells Fargo. You've got Goldman Sachs' fraud charges. You've got investors filing their own lawsuits against Blankfein and some of the heads of Goldman Sachs. So are banks a safe place to put your money in that respect right now?
Well, banks have been the best acting sector off the bottom last March, and for obvious reasons. We had priced in bankruptcy of a majority of the sector. So clearly it makes sense to see them have the biggest rebound. I think at this juncture it's probably a sector you want to avoid for three reasons, and you've clearly stated them. There's going to be ongoing litigation liability. Clearly there's going to be more regulation. But most importantly, even if we change the rules of the game, this is going to be a sector that's going to be reticent to use the kind of leverage that it's used in the past. So it's not going to be as profitable on industry, regardless of how much the economy returns here. So there's going to be new rules to the game. There's going to be a delevered business model, and there's going to be that sort of ongoing risk of litigation liability. So I think you can avoid the major banks in general.
And then looking at the Fed meeting this week, Tuesday and Wednesday, most aren't expecting any change on interest rates, but the big question is, what will the language be when the Fed does come out with the decision?
Yeah, it's interesting. The Fed's been very consistent over the last three meetings, leaving in the duration of time that they're going to keep rates low. I think that'll be consistent now. If you try to read the tea leaves through all the Fed speakers we've had since the last meeting, clearly it's a consistent feeling. The only thing that may change a little bit is how they talk about assets and when those are going to be for sale. Now remember, they've got about $1.3 trillion in mortgage-related assets on their balance sheet right now, and at some point in time they're going to need to offload those. And we make the argument they need to sell those before they start raising rates. So we may get a signal about asset sales, but I certainly think as far as everything else goes, I think we're status quo probably throughout the balance of this year.
All right, and then looking at Goldman Sachs, Art, specifically, what's your call on this? Because, listen, I've talked to a number of well-regarded bank analysts that say, kick the top management out at Goldman Sachs. The firm obviously has a PR issue, but ultimately they see the stock as a sound investment. Do you agree?
It's hard to say. You sort of try to equate this to what happened at Toyota when they had the same sort of, image tarnishing event, and then how quickly they were able to spin the PR machine to get things going again. It's really hard to know until this plays out in a public court. I would tell you this: you have to sort of step back and see how this case develops, and if it's the cockroach theory, is there a lot more behind this? Is the SEC just sort of leading with its best case, or with the only case they have? And we're not going to know that until we do. So, it's one of those things where I don't think Goldman Sachs is an investment for widows and orphans, certainly. But it's certainly a great trading opportunity for the people that like volatility.
That's a good way to put it. And finally, the biggest risk, what do you see, Art, to this rally? Is it oil prices? Something we don't talk about. I'm looking at crude futures now. We're right around $85.
Yeah, I think $85 is kind of like that line in the sand, if you will. If we sort of hover around that, bounce around 85 for the time being, I think we're okay. We start inching higher than that, we're going to seriously look at how much of a drag that's going to be on the economy. I think the sort of 800-pound gorilla in the room that we're not talking about is 2011, when we start looking forward to higher taxes, the cost of healthcare reform, things of that nature. And it's probably something that we're not discussing as much. We discuss sovereign debt, we discuss the China demand story, we certainly discuss the cost of energy, but when we really look at it, it's going to cost us more to run a business in 2011 than it did in 2010 with both higher taxes and with healthcare reform. So I think that's going to be the squeeze on earnings growth. And I think when people start focusing on that, that's when we sort of get the caution flags going up in the market.
That's a great point, something a lot of folks haven't brought up at all. Art, thanks a lot. Appreciate it.
Take care.